Hello and welcome to Pro Trader Strategies market commentary for Friday, April the 24th. I'm Eric Wilkinson, and you very well may recognize me as the Wolfman from mainstream media, where I've talked about everything from the economic, geopolitical environments, and then how that impacts the overall market with my market analysis. Well, I do that same stuff in these daily market commentaries, but I layer on top of it some option strategies that I find to implement into our portfolios around those assumptions we come up with. Yes, I have specific rules, and I just did a webinar yesterday on it, on protecting our bond portfolio. I implemented a strategy in and around that as well. Today, we'll talk about that a little bit later, but I go through and have several, or not several, I have a couple of guidelines that we need to follow in order to implement specific option strategies into our portfolio. All right, so it's not just going out there and buying a call because you are bullish. There are certain environments that we need to have in order to implement that strategy so that we can increase our probabilities of success. We also talk about the days to expiration that we need in order to do that. So check those out over at protraderstrategies.com and let me know what you think. You can email me at trading@protraderstrategies.com as well. All right, let's get on with the economic data, see how that's impacting the markets today. We've got a couple of good economic data points here in the United States. These are going to start showing up with the COVID crisis that we've had. So it's going to really start reflecting going forward what is going on in the economy. And we got core durable goods. Now, core durable goods is the things that we buy that last over 3 years, generally speaking. So like cars, washer and dryers, microwaves, TVs, stuff like that. Well, core durable goods strips out transportation, all right? So with that being said, we've got a negative 0.2%. That was expected to be in negative territory, but it was expected to be a negative 6.1%. So a lot of people going out there and basically buying TVs. Maybe they're sitting around and like, God, I hate this TV now and I want to buy a bigger TV. And those are things that we're starting to see. I've been talking about this. Something we saw with Target not too long ago was their sales the last couple of months were up 100%. One month, I can't remember exactly what month it was, and then another month it was up over 200%. So people are going out and buying at those type of stores. I think the online guys are doing really well because people are sitting around, like I said, watching TV and wanting a bigger one. They order it online or something and have it delivered. Well, durable goods, well, we're adding back in that transportation, came in at negative 14.4. That was expected to be a negative 12, all right? So worse than expected on the transportation. That's not unexpected, to be quite honest. I mean, who really wants to go out and buy a new car when they aren't driving anywhere? They're stuck at home. So those types of purchases aren't happening. As a matter of fact, I have a friend that owns a car dealership in Indiana, and they are really struggling, which is kind of really sad to see, quite honestly. All right, University of Michigan consumer sentiment. That came in at 71.8, expected to be 67.8, higher than expected there. That's a bit of a surprise, to be quite honest, but I guess people are sitting around the house and, we were seeing that number in the hundreds to just to make everything. Sorry, I've got my news squawk on. I'm going to shut that off. Something to note about that news squawk, I forget about it. It's running in the background all the time. And they throw out news stories and stuff like that as soon as they hit. So it happens a little bit faster than what we're going to see on something like CNBC, or if you're trying to read the news, if you will. They squawk it out as soon as they see it, and it's a great service if you want to check that out. Just tell them that Wolfman sent you, all right? Because it is something that helped me out quite a bit yesterday. We'll talk about that when we're talking about Gilead. Gilead has the remdesivir, and the trial over in China really kind of fell on its face. It didn't show any improvement in these COVID cases, so they had a pretty wild ride yesterday. I remember had short puts on in there, and we'll talk about that here in a minute. I got out of those. For profit, believe it or not, it was that much of a wild ride. The markets in that were for my, I think they were the, the 85 puts in there, basically were zero bid at like $5. It was pretty crazy. So anyway, on with the overall markets, how that's impacting. We've got crude oil moving a little bit higher today, up into 16 now. But the fact of the matter is there's just still no demand, right? Until we start opening up the economy, start opening up some of these factories, we just are not going to see any demand coming through that end of the aspect. Now, gold is coming off a little bit. I'm still bullish in gold, you guys, with economies of scale really printing at the press, and especially here in the United States. That should weaken the dollar, and this is a dollar-denominated product, so that should give it a little bit of a lift. I don't have any positions in gold, but I do believe it's going to stay elevated for quite some time, and at least in the 1700 area. All right, the bonds, up a few ticks, really. Not a whole lot to see here. The markets are pretty quiet, especially for being a Friday. One thing to note is it is a Friday and nobody seems to like holding on to stocks going into that weekend. So we could see a bit of a flip heading into the end of the day with equities coming off and giving that a lift over there in the bonds. All right, the VIX is off by about 2 points here, breaking below that 40 handle. You know, we've talked about 40 is the new 20, and it's going to be interesting to see how long we can hold on to these elevated levels of volatility, even with the coronavirus and the lockdown happening. I think we're going to start to see that VIX start to slide a little bit more as things start to calm down here. All right, we've got the Dow Jones Industrial Average up about 27 points only. And I say only because we were above that 9-day moving average, as we can see the line in the sand there. The 9-day moving average was pierced. We were up over 200 points on the day, as we can see right there. That's where we were trading, up around 200 points. That was pretty much off the open, but we're starting to see a bit of a slide heading into the end of the day. I would not be surprised to see the markets be in negative territory by the end of the day. Something to note with the NASDAQ, we are in positive territory here, up 0.5%, up by 40 some points. Tested that 9-day moving average. I don't think we really got through it, but it's lined up quite nicely with the value area high. We talk anytime we start getting above these areas right here, that's a value area high where 70% of the volume and trading time has been spent in this area here. So that is where the market wants to migrate to. And I think that we've gotten a little overextended, a little ahead of ourselves. And most of the equities, S&Ps have been a little bit of a dragger there, but NASDAQ showing that people are ready to put on some risk. Yeah, I do believe in the tech sector, which is tech heavy here in the NASDAQ, because I think people are building out their home theaters and their home offices more so. But that is giving them a little bit of a lift. But having said that, to say that, we are at an area where if we look in and around this area, I can probably throw up a straight line. Let's try and throw a straight line up here and draw that across. To me, to be positive on the year is a little bit of a stretch, right? I mean, we know the economy shut down. When we were at the beginning of the year, we were seeing those record low unemployment numbers. Now we're at 15, which is like the 30s. So really seeing the market get, in my eyes, slightly overextended here, to be honest. And then we move over to the E-mini S&Ps. You can see we're still in positive territory on the E-mini S&Ps. This is the one that I was saying I was lagging a little bit behind, compared to like the NASDAQ really blasting off and at its value area high up here. We're seeing at least the E-mini S&Ps have gotten back into the value area here, where the most time and volume has been spent. Hasn't quite been able to get up there to the point of control, where this is absolutely where the most volume's been spent, and here we've got where the most time has been spent. Those are comfort zones. That means that's where a transaction has happened. Anytime we get overextended to the upside or the downside, people want to cover those trades. So they have a tendency to bring it back into line with the point of control. And these are really important things to keep an eye on right now with the uncertainty we have going on, that markets will want to somewhat migrate to those areas. On stocks as well, you guys. All right, so here we have the E-mini S&Ps. You can see right on the open, we did come and print those highs. That's where we were seeing the Dow Jones up a couple hundred points. But as the day winds on, we are seeing more and more weakness. Now, most of this over here, it was the fact that we heard about Gilead coming out, or not really Gilead saying, it was China saying that Gilead's remdesivir was not really doing anything for the patients over there in China. So Gilead took a wild ride. Today, I think we're seeing some more weakness here because another drug, which was hydroxychloroquine, saying that isn't helping anybody. As a matter of fact, chloroquine is, I saw somewhere it said that the main result of chloroquine was death. All right, so definitely not helping the situation with something that is, on the precipice of killing people. Well, the chloroquine causes a lot of heart issues, and those heart issues are exacerbated by another drug, which I can't think off at the top of the, azithromycin, sorry, which is basically aspirin. So when you take azithromycin and chloroquine, that really is a death punch to the people that have coronavirus. So really trying to back away from that. That's caused a little bit of weakness today, I think, as the overarching feeling in the market is, all right, well, those were the two drugs that a lot of people were hanging their hats on that would help us through this whole situation, and both of those have basically fallen flat on their face. All right, so let's talk about a couple of my trades yesterday. During all of this, you can see the massive sell-off. I actually caught it when on a bounce. The market took a nice little bounce here, as some people were saying, what is China's result? What is their real angle here? Do they have maybe a drug that they want to try and tout to get us out of this whole pandemic? Well, there was a lot of rumors flying around yesterday, and this market was just a whipsaw throughout the time. Here, let's throw this onto a daily chart. We'll go on a 15-minute chart. So you can see yesterday, this doesn't even really show the massive swings we were seeing, but you can see on a 15-minute chart, it took a nice little bounce. This was on the original news that I heard on Rand Squawk, and I basically jumped over to News Squawk. They're changing the name. It's been bought out. It's actually now called News Squawk. So flipped over to my trading platform and put in my May bid for those 65 calls. I said they were the 85 calls. They were 65 calls, sorry. So I did the May, and if you guys remember, just on the 14th, just a few days ago, I had sold the May 65 puts in there because I believed that they had something going with this remdesivir, and sold those 65 puts for $1.05. Yesterday, I was lucky enough on the bounce that we got back right in this area here. I missed it on the initial downswing. As a matter of fact, that's where I was talking about the bid on those 65 puts was zero bid at $4.50. I put in a 67-cent bid. The 60 puts were 70 bids. So I put in a 67-cent bid in the 65 puts just to get it a little bit better. And we got that pop there, and I got filled on that move. So I'm out for 67 cents on Gilead. Now, yesterday we also did a webinar on bond portfolio protection. I talked about this in that webinar. And here, I'll throw up the this right here. So let me do the slideshow from this current slide. So as you can see here, I don't know if you can, it's kind of caught in there. right now we're basically at 0% interest rate, maybe 1% on the bonds, right? So I talked about this in that daily market commentary, in that webinar on bond protection. Well, if we are right here right now, you can see if you had, let's just call it, the bond price is 200, but we're going to call it, you put $200 in that, into that, or $2,000 into that couple of bonds, well, or 200,000, depending on what your size is. If the interest rates go up by 1%, you can see right here that that bond price has dropped dramatically. As a matter of fact, if it goes up to 2.5%, you can see you have lost about 25% of the value in that bond. Sure, if you hold it for 30 years, you can get the face value back. But in the meantime, you are getting crushed. Most people only hold their bond portfolio or bonds. Let's discard this and close it. For about 7 years. So in that 7 years, we can imagine that bond prices are going to go higher, bond prices are going to go lower, because remember, bond prices and interest rates, if we start to see interest rates go up, right? Well, that means that the price of the bonds goes down. It's basically, we can look at it like a teeter-totter, all right? But those bonds, for every 1% increase in interest rates, that's about a 15% decrease, 10 to 15% decrease in the price of that bond. So in that example, you put in $20,000 and you got a 10% cut on that, it's only worth $18,000, right? 1 percentage point increase. So not really a time to be buying bonds, but some people have to. And if you are, then we are looking to sell some calls in here. And that's exactly what I did to help protect some of my bond portfolio. No, I don't have them in my major trading account, but I have a IRA, I have a 401k, and in those, that's where my bond portfolio is. That's where I kind of look at it as my risk off kind of trade. I have, my higher risk trades going on in my trading account. So to balance that out, I have more bonds over there. Well, I can still hedge that bond portfolio. We look at this as a total portfolio, or I at least look at my entire investments as an entire portfolio, right? So going in there and trying to hedge some of that's going on over there in my bond portfolio, I went in and sold some calls in here today. So I basically, I'm looking to hedge probably 50% of my bond portfolio, because I don't know if we're going to go into negative territory, but I do feel like this is a pretty good benchmark. I mean, that was historical unprecedented lows. Now, I didn't think we would see negative rate or negative pricing in crude oil, but it happened. Do I think that we're going to see negative pricing, negative interest rates over here in the bonds? I don't think so. I don't think that's going to happen here, at least in the United States, but it is a possibility, and that's why I'm not going to hedge the entire bond portfolio, right? So I went in and decided to do the May. I sold my May, and I got my pricing because volatility is high. I'm following my rules, which we laid out in this webinar, was for something like an ETF, we're looking at high volatility being something above 30. Well, that meets this bill, and I went in there and did it at around the 16 delta, which ends up giving me my 181 calls. Now, when I did the daily market commentary, when I did the webinar yesterday, pricing was a little bit better. We were off a little bit today when I put this trade in, so I had to go a couple of ticks down. I was looking at the 183 calls yesterday in that commentary, in that webinar. I don't know why I can't get it straight. And I ended up selling the 181 calls here for 99 cents. All right, so that 99 cents is a credit. Well, I got a credit added on my break even, so my break even is for this trade is at 181 now, $181.99 or at 181.99. So as we can see here, I am, 2 full ticks above that all-time historical high in TLT. So I feel pretty comfortable about that. If we get up there to all-time historical highs, that means the bonds in 10-year are well below 1%, and that's a pretty crazy scenario. Not to say it can't happen, but that's why I'm being a little bit more cautious on my sizing of this trade versus what I own in my portfolios. All right, so that's what we've got going on for today. Haven't added anything else or taken anything else off, but I hope everybody has a good weekend. Stay safe. Take a visit to the garage this week. It's a good vacation. Just pop that thing up and social distance by looking across the way at your neighbor, maybe. All right. One last thing we got to do is really talk about this, and that is because we are an educational company. I am not trying to give you guys any type of trade recommendations. Everything we talk about in this is for your educational purpose. I don't know your risk parameters, so there's no way I can tell you what to do. All right, so if you can't take that, take it easy.